Hello, everyone. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's YouTube Live video, tax savvy solutions for rating your retirement account. And rating's just a bad word. I hate that word. I shouldn't have used it. It's really just tapping in, because the whole point of today's video is finding the best solutions, tax savvy solutions, for tapping into your retirement account to pay for a personal expense. And what really drove me to do today's video was because of these just eye-popping debt numbers that have been, part of our news cycle. And I'm going to throw some numbers at you that kind of explain what got me thinking about, hey, how can I educate people to explain the best, most tax-savvy, most tax-efficient ways to use some retirement money to help pay for escalating credit card debt, auto loan debt, state and federal student loan debt, right? Personal debt. It's a big issue. Okay. Inflation has been a problem, right? We're at almost 20-year plus highs in interest rates. And it's expensive, right? Whether you're going to a local diner or just going to the grocery store or just going out buying a meal, drinks, going on vacation, it's super expensive. So I put together these numbers. I thought kind of set the table for today's video. So it's about a little over $1 trillion in credit card debt. This is as of Q2 2023. It's about $1.77 trillion in student loans, federal and state, as of second quarter 2023. Okay, that's up 1.25% from the second quarter of 2022. Okay, $128 billion of the total through March 31st, 2023 is private student loan debt. Okay, American households carry a total of $17.1 trillion in debt as of second quarter 2023. There's approximately $1.58 trillion in auto loan debt. Okay, I'm just kind of throwing some big numbers at you. So when you look at everything, you look at student loans, credit card debt, household debt, personal debt, it's tough. Okay. The average personal loan debt is about $11,000 as of quarter one. The average household debt is over $101,000. And yes, that includes obviously a mortgage. The mortgage debt is $12 trillion. Now, I get that. That's okay, right? Hopefully, we've all gotten lower interest rates because of the fact that we refinanced during COVID when rates were 3-4%. Now, much higher. So, the prime interest rate is now 8.5%. During COVID, it was 3.5%. So it's definitely, the cost of money is expensive. So now let's get into the heart of today's videos. What is the best ways to tap in to your retirement account to pay off some of this debt? And I'm going to start with the first one, which is 401k loans. Now, 401k loans gives you the ability to borrow the lesser of $50,000 or 50% of your account value and use it for any purpose. Okay, so pay off loans, go on vacation, whatever. Now, the beauty of the loan option is, number one, you get tax-free, penalty-free use of it. So you don't have to pay tax or penalty to use it. Number two, you can use it for any purpose. Number three, the interest on that loan goes back to your 401k. Okay, it doesn't go to Visa or MasterCard, it goes to you. So yeah, the prime interest rate, as I mentioned, is now 8.5%. That's much higher than 3.5% during COVID. But if you look at the bright side, the higher interest rate is going to you, right? It's not going to Visa or MasterCard. Now, 8.5% is high compared to the prime rate during COVID, but much, much, much less than you're paying on credit card debt, which is probably in the upwards of 20+%. And I've seen 23 to 28% on some cards. So if you can reduce and consolidate that 23 to 28% in credit card debt down to 8.5%, up to $50K that you're paying yourself back, that's a home run. That's a win-win. You've reduced your debt from 23 to 8.5, and that 8.5, instead of going to MasterCard or Visa, is going to you. So you're guaranteed on your loan investment of $50K, you're guaranteed an 8.5% rate of return, which is good. Even though inflation's running at 4 or 5%, 8.5% beats that. So that's really good. So to me, that's the best solution. Now, if you're self-employed, you can set up a solo K for your self-employed business, your sole proprietorship, your C Corp, your S Corp, your partnership. The only requirement is you have no full-time employees other than the owners or their spouses. And a full-time employee means 1,000 hours or more, 3 consecutive years of 500 hours or more. So if you're a 1099 or you have a single member LLC, sole proprietor, maybe it's just you and your spouse or you and a partner, as long as you have no non-owner employees that work more than 1,000 hours during the year, you can set up a solo K. And then let's say you roll in 100K from a previous employer 401K, you can now borrow 50K, tax-free, penalty-free, use it for any purpose. It's a 5-year loan. You got to pay back at least quarterly, but that 8.5% interest on that 50K is going to you. Now, if you only have 30, you can borrow 15. But again, if you can reduce the 23% credit card debt or 25% down to 8.5%, and that 8.5% is going to your plan as a return of investment, to me, that makes the most sense. And I think that's the first viable option. Now, most plans do offer 401k loan options, but if yours doesn't, you have the secondary option of if you're self-employed, even if it's a business where you generate $1,000, $2,000, $3,000 in income each year, you can still set up the plan really just for the loan. And this was super popular during 2009, 2010, set up lots of plans where people were just like, literally, I need the plan for the loan option. I don't really care to put away money at this point. I need to reduce debt. And that's the main purpose for establishing the plan. That's okay. You don't have to make 401k contributions. It's not a requirement, but you have the ability to obviously benefit from that loan option. So that's the first tax savvy solution. Number 2, hardship distributions. What are hardship distributions? And I'll go through and start with 401k hardships and then turn to IRA hardships. A hardship, you still have to pay tax on what you pull out, but you escape the 10% early distribution penalty if you're under the age of 59.5. If you're over the age of 59.5, you're not going to need a hardship because you can generally pull the money out without 10% penalty. So let's talk with 401ks. Now, Secure Act 2.0, which was passed December 2022, now makes it easier to essentially certify that you have a hardship. Before Secure Act 2.0, you basically had to prove to your employer, and it was uncomfortable because you kind of had to go through some details and talk about what is really at issue with you and your financial situation. So something that Secure Act 2.0 worked through, which I think is a really good thing. So how do you prove hardship? Well, number one, you got to show an immediate and heavy financial need. Okay. You need to limit it to what you actually need. What are some other safe harbor ones, which is put in the code in 2017? Medical care. Okay. Cost directly to purchase principal residence. Tuition. Okay. What else are some of the foreclosure, funeral expenses, repair damages to a home? And again, you need to take what is basically needed, and it's limited to what you really need. And you basically can't have to show that you can obtain the funds from other sources like insurance or a loan or things like that. But the good news is certification now, self-certification is much easier. And that's the most important part. Okay, so remember, hardship, you still have to pay tax, but you escape the 10% penalty. IRA hardships, less important. Why? Because you could pull money out anytime in an IRA. A 401k, you need what's called a trigger event to pull money out, which generally means you leave your job or you're over the age of 59.5. With an IRA, you can pull your money out anytime. Yes, if you're under the age of 59.5, you have to pay a 10% early distribution penalty. So what are the hardships? Again, you can have to show financial hardship, unreimbursed medical expenses that exceed 7.5% of your AGI or adjusted gross income, qualified high education expenses. There's a purchase of a first-time home buyer, which is unique to an IRA. It's only 10K. And other, obviously, immediate and financial needs. Okay, so again, this is something you'd have to show the IRA custodian, and then we would obviously code it as a hardship on the 1099-R, so the IRS would know you're treated as a hardship, and you wouldn't have to pay the 10% early distribution penalty. So another option, again, we all wish we're not in these situations, but it happens, right? Things happen where you need to um, tackle these issues. And sometimes the only way to do it is through um, a hardship. So again, just so far summarize where we're at. 401k loan or solo K loan. If you have a 401k hardship, you can self-certify, or if you have an IRA hardship, the most common ones are financial or medical. Okay. Now let's talk about Rule 55, which is a cool little rule. Rule 55 only applies to 401k plans. And essentially what it does is if you leave your job, whether you're terminated, you quit, whatever it is, and you're over the age of 55, okay, it's only for 401ks, not IRAs, you can pull out whatever you need to live on because you're below the Social Security age without the 10% penalty. Still have to pay tax, you escape the 10% penalty. And you can pull out whatever you need, whether it's $1, 10,000, 20, 15, whatever it is. But it's only for 401ks, and you got to leave your job 55 or over. It doesn't work if you're 49 years old or 53. Okay, 55 or over, only for 401ks. You escape the 10% penalty, but you still have to pay tax. 72T rule, also known as substantial equal periodic payments, or SEP. This applies to IRAs or 401ks. This is a cool option too. A lot of people aren't aware. A lot of people confuse the 55 and the 72T. They're totally different. Okay, 55 only applies to 401ks, only applies if you're 55 or older. 72T applies to anyone. Okay, IRAs or 401ks. What are the differences? That's one difference. It applies to IRAs or 401ks. Number two, you can't take whatever you want. You have to take out a certain amount based off a life expectancy table, and you have to take out for at least 5 years. So let's say you need 20K, okay? But based off this life expectancy table and you're 50, I don't know, let's say 5, you'd have to take out a certain amount for at least 5 years till you reach 59 and a half. If you're 45, you may have to take it out till you're 59 and a half. If you're 59 and a half, you have to take out for at least 5 years. But you're only allowed to take out a certain amount, and it's based off this life expectancy table. You can't just take out whatever you want, like the Rule 55. So that is the main difference between the 55 and the 72T. The 72T applies to IRAs and 401ks, 55 only to 401ks. 55, you have to be 55 or older before you leave, as you leave your job, to have that option. 72T, anyone could use it. 55, you can pull out as much as you want. 72T is limited based off your life expectancy table, and it has to be for at least 5 years. And ultimately, that's the one major downside of the 72T. It's not the 5 years, it's the fact that you're stuck at a certain amount. So for some folks are like, hey, I need to come up with 10K, and they do the 72T calculation based off their life expectancy table, and they only can come up with 1,200 a year. And they're like, it's not worth it. What's the point? I can't do the 72T. But it's important to know that that's an option. And it's not the same as a Rule 55. It's a different option. Okay, so if you have an IRA and you may want to look for ways to escape the 10% penalty, you're not escaping tax. The only way you're escaping tax is the loan. You're not going to escape tax with a hardship, the Rule 55, or the Rule 72T. Okay, all you're going to do is escape the 10% penalty. So you got to figure out, is that even worth your time, right? If all you need is 10K, 10% penalty, maybe $1,000. Is it worth going through all these loops? You just pull the money out. And we'll get there in a second. Okay. So that's the main concept, is understand 72T, 5 years at least. You're limited how much you can pull out each year. And it applies to IRAs and 401ks. The next option is if you're a Rother like I am, let's say you have a Roth IRA, you can pull out the amount you contributed tax-free, penalty-free. So let's say I'm 48 years old, and for the last 20 years, I put $4,000 away in a Roth. That's 80K. And let's say that 80K is now worth 250. Okay, so I have 170 of gains. The 80 of contributions I can pull out anytime I want, tax-free. It's after-tax money. The 170, I got to wait till I'm 59 and a half. The Roth's been open at least 5 years. But the 80 is free money to me. Now, you may say, well, why? It's liquid gold. Why would you tap into that Roth? Well, sometimes you don't have the option, right? I lived through 2008, 2009. I was living in New York City, thought the world was coming to an end, right? I remember walking by Lehman Brothers, seeing people, literally crying, leaving the office with boxes of their personal belongings. Like, I was scared. I was considering pulling all my money out of the bank, right? We went through COVID, right? The times get scary. This is a strange little time. The economy is actually pretty good. Unemployment's low, but we're living in a weird type of wonky interest rate environment. We're not sure what's going on. So people are a little bit apprehensive. Interest rates are super high. And we get it, right? You heard me talk about $1 trillion of debt for student loans, for credit card, for auto loans. Like, we're all there. We all have all these things. And sometimes you just get in a hole, right? There's a medical issue. You need to go on vacation. There's a wedding in the family, whatever. And you just have this credit card hole of 10, 15, 20K, and you just need to wipe it out because each month you're paying a little bit, but the balance keeps growing because you're paying 23% interest on that number. You're never going to get out of the hole. So sometimes you got to figure it out. So that's why the loan option to me is the best one. If that's not an option, then maybe the hardship is. If that's not an option, then 55 is. If the 55 doesn't work because you don't have a 401k and you're under 55, then maybe the 72T is. But if you need more than the 72T, then if you have a Roth, you can pull the contributions out anytime you want. So yeah, maybe you don't want to tap into your Roth contributions, but you're still leaving the earnings. So let's say you have the 250 and I have 80 of contributions and 170 of earnings. Maybe I only need 20. I'm like, yeah, it sucks. I'd rather have it in my Roth, but it's $20,000 tax-free, penalty-free. I got to consider it. And that's really the purpose of today's video. You just got to consider these options. Obviously, in a perfect world, none of us need to tap into our retirement accounts to satisfy these debt issues, but things happen. So just remember, if you're a Rother like me, it's an option. And the last one is just taking a taxable distribution out of an IRA and just saying, you know what, like, what can I do? I'm in this pickle. I got to deal with it. So if you're under 59 and a half, you pay tax and a 10% penalty. If you're over 59 and a half, it's just tax. Yeah, it's not perfect. We all want to keep our money in a retirement account. Why? Compounding returns, tax deferral. Your money grows faster when it's not subject to tax. It's the eighth wonder of the world, but hey, things happen. So that's probably the last resort. You may flip that and say, well, the Roth should be the last resort. Maybe you should hit your taxable distributions before your Roth. I don't know. I'm just trying to figure out the best way to preserve cash flow right now and not pay tax. So that's why I placed the Roth ahead of the taxable distribution on an IRA. Now, one other thing to remember is if you have a 401k and you're under 59 and a half, you're not going to be able to just take a random taxable distribution. Why? Because you need a planned triggering event. You're going to have to either do a loan or do a hardship or Rule 55. But if you're under 55, you'd have to do a loan or a hardship. Why? Because with a triggering event, if you're under the age of 59 and a half, you can't have access to those funds. You can't pull those funds out unless you leave your job or you can satisfy a hardship. So that's why the loan, to me, ultimately is the best for 401k providers and participants. I just think ultimately it's the best way because you get tax-free, penalty-free use of the money. You're paying yourself back at an 8.5% rate of return, which is pretty damn good. And you can take care of debt you need to take care of and still grow your retirement accounts at an 8.5% clip. So that's why I put it at the top of the list. And I put the hardship there because at least you can pull money out if you're an IRA or 401k. You save the 10%, but the money's still in there. It's still, it's not in there, but at least you're saving that tax. The one issue with hardships is leakage. Just like with any distribution, the money doesn't come back. Okay. And actually, the last thing I want to say, and I should have probably put this number 2. I'm sorry I didn't. My summer brain is still kicking in. Is a 60-day rollover. What the 60-day option is once every 12 months, you have access to your retirement fund in an IRA, not necessarily a 401k, in an IRA to use for any purpose for 60 days. So let's say I have 80K in my IRA and I need 10K just to pay this crappy debt off because it's killing me. I'm stressed out. I can't sleep at night. I can take 10K out of my IRA once every 12 months, use it for whatever I want, but I have to put it back within 60 days. If you don't put it back, it's subject to a tax and a 10% penalty. So if you have some cash flow issues, but you think you're going to be able to make good on that distribution in 30, 40, 50, or 60 days, then pull the money out, use it, pay off the debt, and get that money back from another source and pay off the IRA 60-day rollover. So that's another option. It doesn't always work out because it's not easy to come back with that money within 60 days. 60 days is not a huge window, but it works in some cases where it's just like a cash flow issue where you have a bonus coming or you're selling an asset and you're going to have some cash flow coming in the next month or so, and you just need to tap into your retirement account now. Once every 12 months, you can use that 60-day rollover option, take care of an issue, and then push that money back within 60 days. The 60-day rollover, if you take cash out, you got to put cash in. You can't take cash out and put a car in or a house. You got to put cash for cash. Once every 12 months, not once every year, once every 12 months. So just consider that. Otherwise, that's it. That's the solutions that I think make the most tax efficient sense if you're looking to tap into your retirement account. The ones I mentioned, starting with the loan, then the 60-dayer, then the hardship, then the Rule 55, the Rule 72T, the Roth contribution distribution, and then ultimately the pre-tax IRA or 401k distribution if you're over the age of 59 and a half, kind of makes the most sense. I hope no one has to be in that situation, but listen, we've all been there. So it's important to understand the rules. I can't tell you how many people have come up to me and said, "Oh man, I just took a taxable distribution. I'm so stupid. I probably could have done this loan. I'm self-employed, or I could have certainly done this hardship, saved the 10%. Oh my God, I could have even taken the money out of the Roth. I only needed like 20K. I have so much of my Roth contribution." So that's the point of the video, is to educate everyone. These are your options. Consider them. Hopefully you never need to use them. But if you do, you might as well pick the most tax efficient way because it's less money in your pocket, and who wants to pay more tax than they have to. So that's it. I hope you guys enjoyed today's video. It's kind of a bummer topic, but it's important to be well optimized on the facts, on the law, and make sure you know what your options are if you got to tap into your IRA or 401k. Thanks for hanging out today. I really appreciate it. And have an amazing rest of your day. And leave a comment, question. If you're a client of IRA Financial, call us, email us, chat us. We'd love to help anyone, whether you're a client or not. We just want to help you, inform you, educate you, and give you all the knowledge you need so you can make the most educated decision on the best way to invest, and also the best way to tap in to your retirement account. Because hey, things happen, and it's getting tough out there. So best to know what your options are if you need to kind of use some of your retirement funds. So thanks again. Have an amazing day. Ciao.